In the last 48 hours, the Dow just did something headline big. On Friday, February 6th, it closed above 50,000 for the first time. The close was 50,167, up 1,206 points on the day. Here's the promise. By the end, you'll know why that milestone matters less than the wiring underneath it, and you'll have 3 clean markers to track this week. At first glance, it looks like a simple stocks are up story. It isn't. It's a story about who is bidding, what they are ignoring, and where the stress would show up next. Start with the receipts. Reuters had the Dow up 2.47% on the day. The S&P 500 finished at 6,932.30, up 1.97%. The Nasdaq closed at 23,031.21, up 2.80%. Nvidia jumped about 7.8%. AMD was up about 8.3%. Broadcom was up about 7.1%, and Amazon fell roughly 5.6%, even as the AI spend story stayed hot. Put simply, the index hit a record while the market argued about the cost of the build-out. Now, bring in our anchor example. Meet Ridgeline Tools. It's a mid-sized industrial supplier, nothing exotic. It has a $500 million bond maturing in the next 18 months. Ridgeline lives and dies by one thing: can it roll that debt at a reasonable rate? When the Dow prints 50,000, Ridgeline's customers feel confidence. But Ridgeline's CFO feels something else: funding conditions. Because the real question is not the round number. The real question is whether this rally is broad, cheap, and durable, or narrow, rate-sensitive, and one headline away from a wobble. Here's the mechanism chain in plain English. Step 1 is the story investors are buying. AI infrastructure spending is not slowing, and big companies can pay for it. Step 2 is what that does to index leadership. Money crowds into the names tied to that build-out, and into cyclicals that benefit from capex. Step 3 is what happens in the background. Rates and credit decide who gets to refinance and at what price. If those tighten while equities celebrate, you get a fragile mix. In plain terms, stocks can party while financing quietly gets harder. Let's talk about why the Dow led today. The Dow is price-weighted, not market cap-weighted. That means a high share price has more influence than a bigger company, so a handful of big point contributors can move the headline fast. That is not bad, but it changes what the milestone means. And you can see the rotation in the tape. Caterpillar was a major contributor on the day. Goldman Sachs also helped. That's a different feel than a pure 7 stocks drag the market day. It reads like broadening, but broadening can mean 2 very different things. Version 1 is healthy breadth. More sectors participate, and spreads stay calm. Version 2 is late cycle reach. People chase anything not down, while credit quietly stops improving. So, we check the plumbing. On February 5th, the U.S. 10-year yield was around 4.19%. That matters because it's the gravity on every long-duration story. It also matters because it's the discount rate for equity cash flows. If yields rise, the market has to earn the rally. Now look at credit. On February 5th, the ICE BOFE U.S. high yield option adjusted spread was about 2.97%, and the BBB corporate spread was about 0.96%. Those are still relatively tight levels by crisis standards, but the direction matters more than the absolute number. Tight spreads say, funding is available. Widening spreads say, funding is available, but it's getting picky. Put simply, the market can be bullish and selective at the same time. This is where Ridgeline Tools comes back in. If high-yield spreads drift wider, Ridgeline's refinancing math changes first. It doesn't need a recession to feel pain. It just needs the marginal buyer to demand a higher spread. That turns into higher interest expense. That turns into less hiring, less inventory, and less capex. That's how an equity milestone becomes a real economy story. Now, one common misread shows up every time the Dow prints a big round number. People assume it means the economy is automatically strong. But the Dow can rise because a few components rip higher. And the economy can lag because borrowing costs stay sticky. The receipt is the split you can see in one screen. Record equities on Friday, and a 10-year yield still living above 4%. In plain terms, your paycheck doesn't get a raise because an index hit a milestone. So, what's actually happening under the hood? A reasonable read is that investors are trying to reprice the next phase. They want a soft landing. They want eventual Fed cuts. And they want AI capex to be a real demand engine, not a hype loop. The risk is not that any one of those is impossible. The risk is that the market is pulling them forward in time. If cuts come later than hoped or growth cools faster than expected, the rally has to survive with less help. Here are the 3 signals that cut through the noise this week. First, watch the 10-year yield and the 2-year versus 10-year curve. Look at whether long rates drift up even on green equity days. If that happens, it's a sign the bond market is not buying the easy cuts story. The typical lag is a few sessions, not hours. Second, watch corporate credit spreads, especially BBB and high-yield OAS. If spreads widen while stocks rise, that's a warning that risk is dispersing. The lag is usually 1 to 2 weeks before it shows up in earnings calls. Third, watch equity breadth. Track equal weight versus cap weight, or the advanced decline line. If the index is up but breadth is weak, it's a narrow rally. The lag is immediate, and it tells you who is actually participating. Now, bring it back to the timeline. In the next 24 to 72 hours, the question is whether this move holds without another AI spend jolt. If we get a rate-driven headline, the market's first reaction will tell you everything. If bonds rally with stocks, the move looks healthier. If yields push up, that's where the tension builds. For the next 2 to 6 weeks, Ridgeline Tools becomes the lens. If credit stays calm, refinancing stays open. And this broadening story can persist. If spreads creep wider, the party stays in the biggest names and everyone else pays more. And if this persists for months, the pressure point is simple. The refinancing window narrows first. That's where higher yields and wider spreads show up before layoffs and defaults. Now, let's zoom in on what selective actually means. It means the market is not pricing one future, it is pricing 2 futures at the same time. Future A is the confident one. AI build-out keeps demand high. Large balance sheets absorb the capex. Earnings hold up. The index keeps making new highs. Future B is the nervous one. Capex eats free cash flow. Funding stays expensive. And the weakest borrowers get repriced first. That split showed up in one clean place this week. Amazon dropped on the day even as chip names ripped. That is dispersion. It is not panic, but it is a message. Here is why dispersion matters for a finance news channel. In a healthy bull run, leadership rotates. Old winners cool off, new groups pick up. Credit stays calm and breadth improves. In a fragile run, leadership narrows. People hide in the certain stories. They avoid anything with payoff risk. And credit quietly stops improving. So, we need one more mechanism step. The AI spend story is not just tech, it is a capital cycle. When companies announce bigger build-outs, they pull forward demand. That helps semis and infrastructure. But it also raises one basic question. When does the cash come back? In plain English, spending is easy. Payback is the hard part. Now, let's put Ridgeline Tools back on the screen. Ridgeline sells components into factories and warehouses. So on the surface, the AI capex story looks positive. More data centers means more industrial demand. But Ridgeline is not a stock story first. It is a funding story first. Its bond maturing in 18 months is still there. And every time the market gets picky, Ridgeline pays more. This is why the Dow 50,000 headline can mislead. The index can celebrate demand. But the refinancing market can punish leverage. Here's a clean way to see it. Watch the winners in the tape. Semis surged. Cyclicals that benefit from capex helped too. That feels like growth. Then watch the cost of money. The 10-year stayed around the low 4s this week. That is not a crisis rate, but it is not a free money rate either. It is a reminder that the hurdle rate is real. Now, connect that to credit again. High yield. OAS around 2.97% is still tight. BBB spreads around 0.96% are also tight. But the reason we keep bringing them up is simple. Direction changes first, then headlines follow. Here is the second common misread. People say, spreads are low, so risk is gone. That is backwards. Low spreads can mean comfort. They can also mean complacency. The right question is, are spreads rising from a low base? Because when spreads rise from tight levels, it often starts quietly. It looks harmless. Then it shows up in deals pricing, then it shows up in refinancing, then it shows up in layoffs and capex cuts. In plain English, the damage starts in the loan document. So, what is the pressure point here? It is not the Dow falling 2,000 points. The pressure point is the refinancing window narrowing while stocks stay up. That is when the real economy starts to feel it. Now, let's set the catalyst window. In the next 24 to 72 hours, watch for follow-through. Does breadth keep expanding, or does the rally retreat back into a small group? Also watch the news cycle around CapEx. More big guidance updates can swing sentiment quickly. The market is sensitive to one thing right now, whether spending is a moat or a margin hit. Over the next 7 days, there is another quiet catalyst: U.S. Treasury auctions. They are not just a bond geek story, they are a demand test. If auctions go smoothly, yields can stay contained. If they struggle, yields can creep higher. And if yields creep higher while stocks celebrate, that split grows. Now, come back to Ridgeline Tools for a new consequence. If yields stay high and spreads drift wider, Ridgeline's CFO gets cautious. They delay hiring, they slow inventory builds, they cut back on equipment orders. That feeds back into the very industrial cycle the market is cheering. And that is how the story crosses assets. Rates and credit lead. Equities react later, jobs react last. Let's tie this to your 3 signals again, with real meaning. Signal 1 is the 10-year and the curve. If long rates rise on green equity days, risk is being discounted. The lag is a few sessions. Signal 2 is BBB and high-yield spreads. If they widen, refinancing becomes harder. The lag is 1 to 2 weeks into corporate commentary. Signal 3 is breadth. If the equal weight market lags the cap weight market, the rally is thin. The lag is immediate. Now, let's run the stakes ladder in plain terms. Over the next 24 to 72 hours, the market either keeps broadening or it snaps back to a narrow trade. If it broadens, the milestone looks like a real regime shift. If it narrows, it looks like a crowded bet. Over the next 2 to 6 weeks, credit decides if this is durable. If spreads stay contained, financing stays open. That supports spending, hiring, and risk appetite. If this persists for months, the pressure point is refinancing. That is when Ridgeline Tools becomes a real case study. Not because it is special, because it is normal. And normal companies are the ones that tell you when conditions tightened. So, where does this leave the Dow 50,000 headline? It is real and it is important, but not for the reason people think. It is not a magic number that makes the economy safe. It is a stress test for a market that is pricing growth, spending, and eventual easing, all at once. If you want the clean takeaway, it's this: the milestone matters less than the mix. Are equities rising with stable rates and stable spreads? Or are equities rising while the cost of money tightens? Because the second mix is where surprise breaks happen. Now, let's give Ridgeline Tools one final update. If this rally stays broad and credit stays calm, Ridgeline refinances at a tolerable rate. They keep hiring. They keep orders steady. The CapEx cycle reinforces itself. If rates drift higher and spreads widen, Ridgeline pauses. That doesn't crash the market overnight. It just quietly cools activity. And that is exactly how record highs can coexist with a slowing reality. Here's the recap you can use this week. First, watch the 10-year yield in the curve. If long rates climb even on green days, it's a warning light. Second, watch BBB and high-yield spreads. If they widen from tight levels, financing is getting picky. Third, watch breadth. If the equal weight market can't keep up, the rally is narrower than it looks. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.